Welcome everyone. Welcome to this webinar about, where to buy the effing dip. So where is the dip? That has been the question since we started to calm down. We are now 20% down on the S&P 500. So quickly, a disclaimer, this webinar is not investment advice. So this is, please do your own research, and I do not take responsibilities for potential losses incurred. So buy the dip, don't buy the dip, trash, buy the dip. This is something that we're going to discuss today. Quickly, my background: started to work in 2000 as a cash equity trader in Paris. Moved to London in 2004, worked for 4 to 5 years for a hedge fund. Then I moved in prop trading from 2009 to 2018. Did a bit of mentoring for another company from 2014 to 2017, and we started my own mentoring program in 2018 with the launch of the 4x4 video series in 2019. So 20 years experience trading, portfolio management, long short, hedge fund, long only, and some mentoring for the last 7 to 8 years. So what are we going to be covering today? As usual, we're going to be going through the situation across asset classes, looking at stocks, credit, commodities, FX, doing a quick market review, looking at the recent performances, even if you know all those performances already. And we're going to be looking at the historical S&P 500 drawdowns, because, I think a lot of market participants, especially over the last few years, I've been in the mindset to be buying the dips, always buying the dips, and the market always bouncing. So the question will be normally by how much the S&P goes down and for how long. And then we're going to be talking quickly about, a stupid rookie mistake that if you stop doing it, you're going to be potentially saving a lot of money. So markets, equity market stocks have been under massive pressure. So they are under attack. So if you look at CNBC, this is markets in turmoil, but that is true across asset classes. So as always, the first question we need to ask ourselves is, what are the catalysts going forward? It has been very clear, and I've been saying that since the start of the year, that the market, with quantitative tightening or the central banks being more hawkish, that the markets will experience deleveraging and some degrossing, which has been happening, and that is true across asset classes. Now, where we are struggling is we don't have that many catalysts going forward, unless you think that the war in Ukraine will stop very quickly, or the lockdown in China, same, will stop almost overnight. So there is a lot of bad news, but to be honest, not that many good news. Again, in terms of GDP, China is struggling, 15-20% of the world. GDP, Europe is struggling, 15-20%, and now it feels like the US will be following soon, based on the consumer numbers that are coming down. So not a great picture. We're going to see how long it might last and how much it could go down. Again, why I'm doing that is because I know that the mindset so far and has been buying the dips. So I think from my little experience, one of the worst things, the most difficult thing to do as an investor or as a trader is to adapt to new market conditions. So for 40 years, no inflation; for 20 years, or let's say 10, 15 years, quantitative easing, very friendly central banks. Now the game is totally different. So that means we need to adjust. As we've saw probably over the last year, the last 3 months, last 6 months, there has been a massive sell-off in risky assets. It's not only deleveraging and degrossing, but it's as well a question mark of, how people were doing fundamental analysis and how people were looking at valuation. So for months, years, you had stocks trading on 20, 30, 50 times revenues. And for the last 6 months, market has been saying this is over. So it's time to go back to basics. For months and months, doing the mentoring, doing those webinars, I sounded probably like the boring guy and saying, you know, you need to be careful in terms of risk management and in terms of valuation. And now, guess what? It's knock, knock at the door. Who's that? It's valuation, and valuation comes back with a vengeance. So valuation, risk management. Now, really the question is, you know, how quickly the US could go into recession. So you get the first effect of the market coming down 20%. If we go into recession like we had 10 years ago in 2007, 2008, if you look at 2000, now we are probably talking not about a 20% correction, but more into the 30 to 50% correction. So that is, again, something that we're going to discuss. So quickly, asset classes performances year to date. So now we are into the 20% for the S&P as of today, almost. So those numbers were as of yesterday, almost 30% now on the Nasdaq. So very significant. Emerging market have been holding way better, which is pretty unusual. Currencies are up. Let's go back. Sorry, up if I can do that. So the currencies, US dollar, very strong. As you know, this is a call that I made the opposite for the last 4 to 5%. So I've been pretty wrong on the US dollar, but this is a risk off, pure risk off. So normal to see the dollar that strong. And Bitcoin, as we're going to see in this slide, really has been struggling big time. So making the headlines, down 30% week to date. But stock market, look in the US, down 10% in a week. That is really big. So Bitcoin, a lot of headlines today, trying to do a bit of bouncing on this 28,000, 29,000. It went much deeper on the Bitcoin at 25,000. I'm not an expert in crypto. I've been saying for months as well that as long as the infrastructure and the counterparties are not solid enough, for me, this is a no-go. That doesn't mean that something is not going to be coming out of this space, but you can see how quickly the whole Luna, Terra, whatever you name them, have been collapsing. So we are talking, you know, some crypto that were worth 50, 100 billions at the start of this week, but actually probably with very low participation and very low volume, and went down overnight. So quite something. Tells you as well how much, you know, hot money there was in the system, and there was still in the system as of this week. That doesn't mean that this is over. So in terms of sectors, picture is the same. Energy is the big winner, with WTI being up 30% plus. On the other end of the spectrum, consumer discretionary now down almost 30%, technology more than 20%. But really the big loser on the week to date and year to date has been the consumer discretionary. So it is starting to hurt the US consumer. What's going to happen, and I tweeted today on it, is if you think, we mentioned it in the past as well, you're going to have a negative wealth effect. Okay, negative wealth effect first, because, you know, if you look at your stocks portfolio, if the world is 95% long any assets, that means that those assets are down at least 20% year to date. Crypto, it's going to be some part of the hot money, and some consumption as well went down 50%, meaning that your assets as collateral have been coming down quite a lot. And that's going to affect, you know, the big tickets. If you go to Home Depot, it's going to affect the abilities of the US consumer and some other consumers, obviously, as well, to be buying homes, to be buying flats. So real estate is going to be suffering, and the valuation of private equity are going to be suffering as well. So sorry for this ugly picture, but that's just the reality. I've been saying that for months and months now. In terms of the bonds, so we are roughly at 2.8% on the US 10 years. What has been interesting is, as of until last Friday, bonds were selling off, equities were selling off, so everything was selling off on the back of inflation. Since the start of this week, actually, this is a pure risk-off market where equities are selling off, and in the meantime, bonds are bid. So bonds are going up. So you can look at correlation. So there was a strong correlation between the two until today, 5 days ago. Now the correlation is negative, which tells you that really we are in the risk-off version of the market, which is the old school of, you selling stocks and buying bonds. VIX above 30%, between 30 and 35%, which actually, despite the sell-off in the market this week, it's not jumping much higher. So it's kind of a painful market, but no real panic unless you take those crappy names. So here we got some names that get murdered. So Upstart, View, Yandex, but you got tons of them that lost a ton really over the last week, the last month. Literally, the sell-off started. The selling pressure started from March last year, and the acceleration really from November onwards. Now we got many stocks that are down 50% plus. But what you can tell as well from this earnings season is not because a stock is down 50% that on its earnings, it's not going to go down another 50 to 70%. And I think Upstart was a good lesson for some of the traders. Asset classes, performances, and industries. Just this is the May so far for this month. The picture is the same. Literally, there are tons of industries that are down more than 5%, between 5 to 10%. Software 16%, online retail 20%, cloud minus 15%. On the other end of the spectrum, you get still the biggest and only two winners. The US dollar, energy. But the picture is very much very ugly. Next one. So yesterday we got the core CPI. So we got the CPI. So with the US inflation, always look at the core CPI, where the year to date came down a bit, but the month to date, which is here, it's still I think it was 0.6%. It's still very high, and it's quickening from last month. So in other words, inflation came above the expectations, despite the market selling off before on some expectation that this number will be bad. So there is no slowdown of inflation. So for the last 6 months, we are all be trying to time the peak of the inflation. Unfortunately, this is not the case. And more importantly, that implies that the Fed, if the Fed is data dependent, will not be in a position to say, look, inflation is coming down. We can be a bit more dovish. So that means looking at what we have, and this one is a slide that I used to be putting every 2 weeks, as you remember, telling you how accommodative the central banks have been from 2000 since the COVID situation. So the Fed, we are talking 5 trillion plus, ECB 4 trillion, so 10 trillions, roughly 9 to 10 trillions for the two of them, which represents 50% of the US GDP. So to think that by putting that much liquidity in the system, it has not been impacting the different asset classes, and the prices of the different asset classes means that you are living in a different world. If the central banks, ECB, Fed, really stick with their new phrasing, which is we do have a lot of inflation, so we need to raise rates and we need to reduce, or maybe reduce the balance sheet as well, then that tells you as potentially of the drawdown or the more downside that we have on many asset classes. FOMC meeting, so this is for the next one. We had one recently. So what is priced by the market is on the 15th of June. We're going to have 50 bips. I mean, it's a done deal here. There are some talks. There were still some talks about 75, but what's his name? Powell, the Fed chairman, said, you know, it's going to be 50. But clearly we're going to have 50 bips plus 50 bips plus 50 bips. So really hawkish Fed, hawkish central bank. So in terms of catalyst, if you are keen on putting risks, not easy to find some so far. Let me jump into the, if I manage to do it, where is my, okay. Technical analysis now. So I was just looking at the gold just before the cold. So actually gold is not really making the job. It's down 1% today. Despite inflation, despite risk of inflation has been quite rubbish, which is not really a surprise if you've been following me. This is not an asset that I'm a big fan, but some will argue that that's been doing a better job than the crypto. That is true, but still, if you don't do what you're supposed to do when it matters, that means you're never going to do it. S&P, so S&P talking for weeks and months now, that my first target was 3,900. So today we are at 3,900. Right now, spot it's 39.01 on the future. So that is my first target. That was my first target. So now we're gonna be discussing in the next few minutes about, you know, what is going forward. What is interesting, if you look at that chart, on a short-term basis, since we started to have this sell-off that started five weeks ago. So if you look at the hourly chart, we have been really trading around that trend. So the trend that started on 1st of April, we have been testing that trend for several times. Now today, the level is around 38.70. You don't want to go way below 38.70 because I don't know where's going to be the support. But the slope of that trend is this one so far. So that is something that is tradable if you want to trade it. And I think this is the types of trends that you want to be finding in this market. Let's go into the Nasdaq. So the Nasdaq is bang on its support now. I mean, it's a support. So you see this trend. We are now on it. So there are some signals technically that are telling us that we might be on support. It's true. It's less true for the Russell. So the Russell, you know, I don't like the Russell. I think potentially there is a bit more, and that is exactly what I said a couple of weeks ago. There was another 3 to 4%. So some signal that we are close to a first support. That was my target when we were at 4,400, 4,500, 4,600. So for once I was right. Quickly, some other charts looking at this beast, which was Apple. And actually the technical analysis doesn't look great from here. So I won't be surprised now to see Apple going into this 125. Coming back on the S&P, if you look at the volume profile, for those of you who have access to the volume profile, I don't have it on that platform, but I have it on another one. There has been huge volume on the S&P at 3,900 and 3,300. So first level after a 20% drawdown, that is the 3,900. If we go down 30% from the peaks or 32% from the peak, then we are talking 3,200, 3,300. So we really need to stabilize around this level. Otherwise, we go down another 15%. So Apple doesn't look really great. Today, it's going to be a huge volume. I think now we are already at 100 million shares. It's really going to be a 200 billion shares volume. So that is not a positive when the old market leader, which was Apple, which was holding so well so far, or let's say until 3 or 5 days ago, is now coming down in big volume. And so today, you know, it's down 3% right now, 100 million shares. It was trading, I think, an hour ago, 40 million shares, more than usual. So market participation on the downside is not looking great. Quickly, Bitcoin, because we have to talk about Bitcoin, obviously. So the support, this is the one I was mentioning. Everyone has a look at it. Everyone knows that, you know, the 29, 30,000 is the big level. If we don't hold this level, then we go 13,000, 15,000. So it's going to be a big candle today. There is still a bit of hope that, you know, some new money will come. Really, really important level. You get bad publicity from all those other cryptos. I'm not a specialist, and I don't pretend to be a specialist of it. I never traded. I've been saying for months that the infrastructure, the counterparty is shite. But that doesn't mean, you know, in the future that something could come out of it. I would like to, I'm not going to do it right now, but oh yes, what about we do it actually? I'm going to show you the correlation between the Nasdaq future and the Bitcoin. So if I do that from the start of the year, I hope you can see it. There has been a strong correlation between Bitcoin and Nasdaq. So all those things, they have almost a one correlation or close, meaning that you know, don't pretend to be a genius and to be diversifying your portfolio. Everything is going the same. It's just, again, to me, is de-risking of the market, deleveraging, degrossing, and everyone has to be reducing its exposure. Let's go back and kill this one. Which one I wanted to put? Euro dollar. So after showing you the one where I've been very right, which was the S&P, I'm going to show you the one where I've been very wrong, which is the euro dollar. So at the start of the year, I told you I was pretty bullish at 112, 113. Lucky enough, the stop around 109, 109.5. Now we are below 104. So risk off, still risk off for the euro dollar. Not a good sign for the overall picture. Tells me as well that, you know, this despite the quick intraday bounce, and now we are down. Unfortunately for those who are long, the storm is not over. More and more talks about the parity. I'm not smart enough to tell you where it's gonna end. US 10-year, and then we're gonna go back. So US 10 years. No, I don't want to. I want to have to, in terms of yield. My yield is up. So US 10-year yields, we went almost back to the level that we had in 2019. But as I said 5 minutes ago, what has been interesting this week is yields have been coming down, meaning bonds going up. So there has been decorrelation or negative correlation for this week between bonds and stocks, which is normally what you would like to see in a risk-off market, or historically what you will be seeing. So markets, the way the market has been behaving this week has been different from the way the market was doing until last Friday. So is it a new market? Does that mean that we've reached some peak in the sell-off of bonds? That is, you know, at 3%. So a lot of smart people are saying, you know, the bond should be around 3 to 3.5%, and some others are saying, you know, if inflation stays as high as it is, we are talking 4 to 5%. Okay, but in terms of moves between and correlation between assets, interesting change for this week. Let's go back into the slides. Am I going back into the slides? Up, yes. Okay, so let's go into the next topic. So drawdowns. So here we are looking at the S&P drawdown since 1945. So here we are this minus 20%. So this is for the start of the year. So if you look at this picture since 1945, you can argue that when, sorry for my English, the shit hits the fan, we are not talking like a drawdown of 10 or 20%. We are talking 40, 50%. So as always, what I've been trying to do over those months and years is trying to give you the big picture. You might be trading short term, you might be trading mid-term, but if you don't get the big picture, and especially after these big rallies, that the buy the dip that we had over and over, you are losing the picture that, you know, sometimes the market could be absolutely brutal. So since 1945, that was the 1945, sorry, that was the picture. Since 2000, that is the picture. So we had the sell-off here that we all know, but it was very sharp and very quick in time, which was the COVID. So down 30–40%, but then we bounced back very quickly thanks to the help of the central banks. Two different pictures in 2000 and 2007, 2008, where we had a 40–50% drawdown, and it took quite a long time, you see, to recover from the bottom. So really here there's a question mark, as we're going to discuss. How long and by how much? So bear market, how long and how much? So let's start with how much we generally come down. So I've been doing a bit of exercise and playing with data series on Excel, looking at the drawdowns we had since 1945. So we had 27 of them, with this one included. And on average, excluding this one, the drawdowns have been around 22.7%, so roughly 23%. The median is around 20%. The worst is at 56%. So if you start with all the drawdowns, meaning more than 10% drawdowns of the S&P since 1945, you are talking on average 22%. So all correction since 1945, what is your average drawdown? 22%. So if you are keen on buying the dip, the way you have been doing for years, we are down 20% on the S&P. So we are potentially 2 to 3% close to this buy the dip. So that will give you roughly a 3,700 for the S&P. So now let's go into the next slide, which is what is this picture if you look at the average, excluding the one that we have today. As you can see, sometimes you do have like much bigger ones. Okay, so that's 1973. You get 2000 and 2007. So those ones are the big outliers. And when it happens, that means you potentially have another 20–30%. And obviously that happens when you get a massive recession, or at least when the economy is struggling big, which was the case in 2000, was the case in 2007, 2008, that was the case in the 70s. So the first leg that we had and that we have today of 20% is again deleveraging, less accommodation from the central banks, less liquidities, yields going higher. Now, for the second move, you need to have a deep recession. So if you get a deep recession, if you believe that you're going to have a strong recession in the US and in the world, we can potentially have another 20%. But keep in mind that a lot of those assets have been pumped up massively by those 10 trillion plus, and I'm not taking into consideration the Bank of Japan balance sheet. So artificially, a lot of money, a lot of assets have been pumped up due to this money coming into the system. Now that there is no new money coming, that the cost of money is going higher, that there is inflation, mechanically, you see those assets coming down. So what about if you get a more than 15% S&P correction since 1945? So if you are really in a bear market, then suddenly, instead of being at 20%, 22%, your average is at 32%. So 32%, if you take the, and I'm talking peak to through. So peak to through, and if you take the 4,800, sorry, of the S&P, which was reached in January, then you get a target on the S&P around 3,300. And guess what? Those are big levels. Again, if you look at the volume profiles, if you look at the fights that we had on average, first level is 3,900, second level is 3,300. And as well, if you look at the S&P, if you look at the highs that we had pre-crisis, that was 3,300, 3,400. If you look at most of the stocks, the tech stocks, what they have been doing is they have been retesting or going lower, actually below those levels that we had pre-crisis. So if they were market leaders on the way up, and now they are unfortunately the market laggards, but are pushing the market lower, you can argue that there's a good case for the market to go to 3,300. So let me give you some picture here. So the average correction in red, peak to through, that is your 3,700. Average bear market, sorry, peak to through, really the bear market, that is 32%. Then you go, as I said, around this level of 3,400 that we had pre-crisis. But if you take a step back and look at this picture, you can argue that this move is quite insane. And if you look at a trend, we are potentially, looking at something around here. So not surprising to go back into 3,300, and that will mean everything, not talking about crazy recession, just talking about, normalization of the balance sheet, normalization of the liquidities, normalization of rates instead of going at zero and everything, priced at crazy valuation, going back to levels pre-crisis. So that will be your trend. So 3,300, 3,400. I don't want to sound too bearish, but we reached our first target. I think now we might consolidate at this level. Other than that, the risk is clearly 500, 600 points. Are we going to go into the 3,300 very quickly, or are we going to wait for 3 to 6 months? That I don't have the answer, but that is more or less the picture that I have. So now, second question, it's not only how much, but how long. So how long, if you look at the average drawdown and talking peak to through more than 10%, we are talking 282 days. So that's from the top to the bottom, and then from the bottom to the new highs, we are talking 370 days. But as you can see here, there is a very different timing between those big 1,000, 500, 500. So here we are talking, proper recession. Here we are talking recession as well, and here we are talking recession. So when there is a recession, the peak to through is not going to be 100, 200 days. Okay, these days we are only 128 days into this peak to through. Okay, so 128 is very early. If you believe that this crisis is more important than just some deleveraging, we are talking peak to through of roughly 500, 600 days or 400, 500 days, meaning that you potentially get another year of bear market the way you have, meaning market coming down, and then to recover and to get into new highs, we are talking, another 1,000 days. So sorry for for being like this today. I'm just very factual, so I hope you get it. I've been trying over and over during those webinars to give you some points. Then you decide what to do, but this is what really the numbers are telling you. So if you look at those minus 10% from peak, where we take more than 15% drawdown, and those are the numbers that we're talking about. So the average will be much, much higher. We are talking 400 to 500 instead of 200. So it can be pretty long. So it's pretty funny to look at all those tweets and all those people saying every single day buying the dips. I'm following this guy on Twitter, a French guy. It's got like 90,000 plus followers. And since 4,600, 4,400, every level he has been saying, oh, you should be buying the dips, buy on the rumor, buy, there is a war, no, it's fine. And wrong. And it can last quite a long time. So don't be too early, don't be all in, because, you know, 20%, even if it's painful, if you look at the historical picture of what have been happening in the past, actually, you might have another 300 to 500 days of this bear market. So that's the average. Here, the average, you get 400 days, peak to through, and then to recover 600 days. So overall, 1,000 days, almost 3 years. But literally, if you compare this 128 versus this 400, you get 250 days. So roughly let's say 9 months. So that's the picture. Sorry, don't shoot the messenger here. Next slide. So I spent a lot of time at the start of this week doing going through those series, the S&P series. And as usual on Twitter, then after 3 or 4 days of work, you'll find someone that will put you a nice tweet on but everything you've done. So that is from this guy on Twitter. He's an S&P future trader. You should follow him. He's absolutely brilliant. But the picture is more or less the same, which is a bull market and bear market, by how much and how long it takes. Next slide is the same as well, by how much you have an intra-year drawdown for the S&P 500 for the time being. So that was, I think, 3 days ago. So now we are obviously at 20%. So you should put the cursor here. So you can argue that many of those are below, but you can argue that when there is pain, and that's since 1970, when the outlier is coming, when the storm is coming, you are talking another 20 to 30% down. So what is your risk reward? You decide. We all got different ways of doing a risk reward, but if you're keen on losing another 20%, that means what? You should be able to be making another 60% from where you're buying. If you're using a 3-to-1, if you're using a 2-to-1, that means another 40% upside versus a 20% downside. So 40% downside with an S&P at roughly 4,000, that means you need 5,600 on the S&P as your target to get only a 2-to-1 based on this downside of 20% downside. Makes sense? Risk management. I know it's a bit boring, but sometimes it helps. Another one that I like very much that I found, so this is from this guy, always using your source, putting through the bear market since 1950. So this is what I've been doing. Go through those numbers for those of you who will be watching or are watching now on YouTube. That is quite helpful. Spend some time. It's about understanding, you know, what is really a bear market. Too many investors don't know what is a bear market. Last real bear market was in 2007, 2008, 2009. So literally 13 years ago. The one before was 2000. Other than that, you know, 2020 was just, you know, a very quick bear market. We bounced like in 100 or 200 days. In 2018, December, that was the same. In 2015, very quick as well. So if the economy is bad, if you go into recession, if the Fed, if the central banks, you know, can be very accommodative, you need to be ready of what to expect. The first thing that happens as investors is we reduce exposure on the high beta stories, on the crypto, on the SPACs, on all the dodgy names. I've been saying again for months that valuation matters. And now valuation is coming with a vengeance. Finally, this table from, so I shared it a couple of days ago on the community. So this is from Lombardier. And I think this is interesting to tell you about, as a trader, what is the intraday price action. And the intraday price action of this market is very much the same as 28. Okay, so if you look at how the intraday momentum is versus the cross asset momentum, in 2018, 2020, the correlation was not the same. So in terms of the way the market behaves, it's very much like 2008. And if it's the same as 2008, we are talking not a 20% correction, we are talking between 30 to 50% correction. Again, it's a fact. You decide what to do next, but this is how I do my decision making. So bear market conclusion, how long, how much? If you have not switched yet, I think this is really the time. So stop with the buy the dip mentality that you had for the last 10 years. It has been working. The question is, if you've been making, 100%, so if your asset goes from 100 to 200, if you're only down 50%, you're back to square one. So be extremely careful about people that are telling you, buy, buy, buy. I know that a lot of you have been struggling a lot and actually are below their watermark or below the levels before 2019. So new market conditions, you really need to ask yourself, where is the Fed's put? The Fed's put is not around here, it's probably lower again, much lower. So if you look at stocks and playing the stocks, be careful. I know that some of you have been playing the earnings. You have been following people that have been telling you to play the earnings. If a stock is down 50%, that doesn't mean that the stock cannot go down another 30 to 50%. So again, what has been interesting, and we discussed that before during those last two earnings season, being long single names volatility works very well. So being long the straddle, strangle, something where you were buying implied volatility works very well, which is actually which normally doesn't work because investors overhedge themselves. But that tells you about the brutality of this market. So how long, how much? Now it's about, really understand a time to understand the basics of fundamental analysis. I've been doing that in mentoring. I've been saying a lot of my mentees over the last 3 years, look at the valuation. Do you really think that buying a stock on 20 times sales, 30 times sales is really a good idea? Looking at EV on EBIT, looking at how much the free cash flow generation is there. So start with quantitative analysis. This is not rocket science. You will find some good tutorials on it. Otherwise, there is a brilliant video series with the 4x4, which will help you, teach you how to do it. I do a lot of this during the mentoring programs. So we spend a lot of time during the sessions understanding. And the thing is, my background is I used to be, literally an intraday trader. So this is the way I started. So I have nothing about trading short term, but if you don't understand, where is the market, what is the quantitative analysis, what is the fundamental, what is the valuation, you have no chance. So again, many of the stocks that are down 20% over the last 12 months actually have seen numbers going up. So it's not necessarily about the economy getting that much worse, but more importantly, this is about valuations that have been coming down massively. So instead again of paying, an upstart on 50 times revenue, you're going to be paying 10 times revenues. And even at 10 times revenue, those are crazy numbers. So valuations have been coming down, but they are still very high for some of those names. And again, if you only do your analysis based on P, and I know that some educators are keen on doing P only, you're looking for trouble and you're going to be paying the price. So really be careful on what you want to do with your money, with your capital. And that means in the long run, think about the capital structure of the companies, because the first effect of the sell-off has been valuation coming down massively. Now there is a second question mark, which is if we have and we're going to have an economic recessions, which are the companies which have a strong enough balance sheet to survive? So here I'm going to go into the next topic of today, which is the rookie mistake that we all do when we start. We look at stocks and we talk about a company through its market capitalization, the market cap. So there is, I wrote a post long time ago, so I'm going to put it in the details on YouTube at the end. So stop looking at the market cap only. That doesn't make any sense. You need to be looking at enterprise value. Again, I've been saying it over and over. The first session of the mentoring program, we spent quite some time at enterprise value. Why? Because we want to understand the capital structure of the company. If the company has a business that is financed with debt or with equity, how the company is financing its activity, how much debt, when it's a debt maturing. And that is obviously very important going forward. So what is enterprise value? Is the market cap plus the debt minus the cash. It is important because we're going to go into potentially a recession. And only the companies that have enough cash on their balance sheet, not too much debt, or the ability of generating enough free cash flow will make it. So any ratios that you'll be looking at, or most of the ratios that we will be looking at, we are talking versus the enterprise value versus EBIT versus EBITDA. And anyone that is mentioning only market cap, and I know that there are tons of educators online who are doing it, they are just not worth listening. So don't go for those traps. Unfortunately, investing takes a lot of time, takes a lot of energy. You need to study. It's not like, it's going to happen overnight. The good thing about a sell-off like this, even if it's painful for many investors, it's going to be a wake-up shake-up, as they say at my kids' school. People really are going to wake up and are going to be back to reading books on valuation. So I can help you on this. But in terms of ID generation, I think this is important. So there was this article that I shared with the community recently on Bloomberg saying that, there are now a lot of biotech companies that are trading below cash. So if you think about biotech companies, normally they're going to have 1 to 2 or 3 products in the pipeline. So what is key for them is to have enough cash to survive. So they're going to have what we call a cash burn rate. So every year they're going to be burning X millions of dollars, and you want to make sure that they're going to have enough cash to survive until their pipeline go into phase 1, phase 2, phase 3, and potentially is a big sell. So these days, what is interesting, if you look at that chart, is you have 86 stocks that are trading below, which are cash positive, where enterprise value, is negative. Again, that makes sense for this industry, but interestingly, you could be making a screening based on enterprise value versus market cap. Let me show you. I think I put it here. So here I'm just taking an example. I haven't done the fundamental research, so I'm just taking a name. And why I wanted to show it to you is because I'm just using Yahoo Finance, and a lot of people are coming and say, look, Greg, I need the Bloomberg, I need the Reuters. No, you don't need all those things. Everything is online for free. So here, this is BAM in Amsterdam. But you could do the same in the US, you can do the same in Asia. And it's about comparing the market cap versus the enterprise value. So if the enterprise value is at 75 million and the market cap is at 683 million, that means, in other words, these companies get roughly 600 million cash. Okay, so 600 million cash. What you can do again is do those screenings to see what are the companies that are trading close to an enterprise value to 0 or very close. Biotechs will be normally trading at this level. I own 2 biotechs in Europe actually that are trading below 0. So the enterprise value is below 0 because they have more cash than the size of the market cap. I have as well one company that is trading, so they have exposure. Same, they are trading. So the book value is at 20 and the stock is trading around 10. That doesn't mean that you should only be doing those strategies, but at least in the next few months or years, what's going to be key again is what are the companies that are going to go through this cycle? What are the companies that are going to make it? So now we are still in the phase that we are killing the valuation. we go from high valuation to still high valuation. If you look at, I'm doing those screenings every single day. I'm looking at Square, I'm looking at Upstart, I'm looking at Affirm, I'm looking at all those names. And I'm like, even, we can go another 50% down before the valuation is really, really attractive. So that doesn't mean that in between we can go up 50%, but, cash is king. And you're going to realize that for the companies, you probably realize that these days that cash is king. In your portfolio. Interestingly, just I'm going to show it to you. Can you see my screen? Yes, I think you can. So that's for the S&P. So we are testing again this trend from the on the future. So this is a level. Again, I don't take responsibility for any losses, but this is the trend that you have. Okay. So if I was not doing this call, I will be trading right now the S&P futures. But coming back to valuation, enterprise value, do a bit of research and work on it. So why I can help you, webinars like this one, but we are building the community all together. I think it's getting bigger and bigger. I really enjoy it. So we get more and more participants. Today we just added something new, which is special situation. So we talk about macro, we talk about market conditions. Obviously, in a day like this one, we are talking, we get much more interaction. This is something that I think is key for any traders. I know that even if people are not going to say it, that many traders are struggling first and are struggling at one stage. I'm not in the camp of, those educators that pretend, that the trader is always making money. Those ones that are telling you this are just sales traders, they are just salespeople, they are just lying. It's a tough one, and having a community is very helpful. And keep in mind that you have people that are going through the same process as you. They started at one stage and now they want to get better. Next one is the video series. So based on my 20 years experience as a portfolio manager, based on helping retail traders for the last 7-8 years, I know where you're struggling. I know what you need to have for your infrastructure. I don't know everything. I'm not in that camp again of being arrogant. I think I can help. And those products, the 4x4 video series has been helping some people. Mentoring is for more advanced people, more advanced traders. It's one-on-one sessions where we build over 3 to 5 months your portfolio. We go through market conditions, we go through fundamental analysis, quantitative analysis, risk management, a lot, how to structure the trade. So things that you do as a trader every single day. And hopefully, I'm getting better as a mentor and I'm more helpful than I was a few years ago. So this is what I do. If you get questions on the mentoring, on the video series, on the community, you can obviously reach me on the website, on Twitter, send me an email. If you like what I do, just, retweet, just to put a like, that helps. Really, I think this community could get even bigger and more powerful. That is it for me today. There is some questions. Question on volatility for the next few months. So that's from Jura. It's a very good question. I think the volatility, actually, if you think, as I said, for this week, has not been moving much higher despite the bad market conditions. So 30-35% is a high level of volatility. To go into a higher VIX, you really need like a Armageddon to happen. So be careful. The bottom line of this is when the VIX is at 30-35%, when you are a newbie, when you're a new trader, we all do the same rookie mistake, which is going with options, going for options, and we buy some premiums on calls or puts, whatever, long or short, and we pay a fortune because implied volatility is very high. So what could happen is the market still goes down, but implied volatility goes down as well. So be careful on understanding the drivers of options, which is through the Black-Scholes models. If you get it, that's going to help you. For the time being, I do very little with options, much more with cash, with ETF, with futures than I was doing, 6 months ago with options. I think this is it for today. So I will be posting it on YouTube. So 3870, this is the trend level. Is it going to hold? Is testing on the S&P? Any questions, any ideas on what to do, on topics that you would like to discuss? Please let me know. I think it's a two-way conversation, hopefully. Thank you for joining today. Thank you for watching later on YouTube. And I'll see you probably in 2 weeks. Be safe and be careful. All the best. Bye-bye.